Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
Good evening, everyone. I am Michael Hartzman, along with my partner, Dominick Tavella. And today is Tuesday, March 23rd, 2021. So, Dom, the market seems to have lost its confidence in the warm blanket that's been the Federal Reserve for the last year or so. And every time the Federal Reserve speaks, it seems like the market is not believing what they're saying. It's been really fascinating to watch the last couple of weeks.
We've watched interest rates start to get higher. They've gone up substantially higher from where they were a year ago, when the financial part of this crisis really hit the storm button. But now the last week, I think markets are starting to rethink the reopening trade. And I think a lot of that has to do with how we're dealing with the virus. I mean, the good news is that we've had now in excess of 125 million vaccinations given. But there are some issues around the world, especially Europe right now. And we saw the reopening stocks last week actually take a step back. The S&P was down about 1%, and a continuation of that today. So none of this should be shocking. It's never going to be a straight line up or down. So none of it should be shocking. I think it's kind of normal.
It is kind of normal, but as I said, you know, if you look back almost exactly a year ago when people were so fearful, you know, the Federal Reserve basically said that they were going to buy $120 billion worth of securities, bonds, whatever they had to keep the liquidity going and the markets flowing. And that really is what really was the beginning of the rebound of the market. And it just seems that now every time Jay Powell speaks and tries to reassure where we are with interest rates, the market doesn't even believe him because Jay Powell testified last week that they're going to keep interest rates steady until at least 2023, but the market's pricing in an increase either by the end of this year or the beginning of next year. So there's definitely some concerns about the vaccine, and the reopening stocks have definitely taken a step back. But I also sense this underlying worry as well about inflation in spite of the Fed's best efforts to assuage that.
So a year ago, Mike, you know, the Fed stepped in, and you can almost argue that the bond markets froze up, right? The money markets froze up. And so they agreed to step in. They agreed to buy just about anything that somebody wanted to sell, municipal bonds, things that they haven't done before, at least to my knowledge. And that really created a floor that we could work off of and recover, which I think, you know, we've done a pretty good job. The markets have done an excellent job in doing. But today, if just to look over the last 3 months, 6 months, the interest rates have gone up where the 10-year was yielding about 0.6. Now it's 1.6, yet the Federal Reserve really hasn't done anything to push interest rates higher. It's the market demanding to be paid more if inflation, in fact, is going to be there. And the fear of inflation, I think, is driving this bus to a great extent. The last week or so, the dynamics are changing a little bit. And I think still come back down to how quickly the economy here in the U.S. is able to open, how quickly our economies around the world, specifically Europe, are able to open. They've hit a real bump in the road there. So I think it's about the reopening trade and how quickly it will materialize.
Yeah, I mean, there's no question. I think the market got over its skis a little bit with optimism about the reopening trade. But to your point, you know, we're not living in Europe. And people here are still very excited about hitting the road, taking their vacations. That's why the price of gas has gone up. So I don't think we as financial experts and economists like our guest are worried about that. But I don't really think a lot of, the average investor is really worried about what's happening in Germany, to tell you the truth.
Mike, you're spot on. And I think the noise and the daily headlines and the market went up this much or down this much can only lead our average client, the investor, to maybe get some fear back into this and maybe get them to do something they really shouldn't be doing. So get past the noise, get past the fear, stay eye on the ball. And that is at 3-6 months down the road, this economy is going to be substantially better than it is today.
Absolutely. And then the GDP, and I'm sorry, the Federal Reserve did predict that they project GDP going from 4.2, which was their projection, now to 6.5. 6.5 is an enormous number, which obviously would create inflation worries as well.
Well, and Mike, you and I both know, we've heard some of our private conversations with some of the Wall Street's, smartest people, that number might even actually be conservative. So we do expect certainly the end of second quarter, third quarter numbers to be substantially better. And we might be looking back and going, that was just a little bump in the road. We got through it and we're better off for staying the course.
So on that note, we're going to take a quick break and we're going to come back with John Eade from Argus. John joined us about a month and a half ago, and we're delighted to have him back, and he'll provide his insight on what he's seeing as well. So we'll be right back.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report.
All right, I'm Michael Hartzman, along with Dominick Tavella, and we're back tonight with John Eade, Director and Portfolio Strategist at Argus Funds. John, welcome back. I know you were on the show about a month and a half ago, and I think you heard our open, and why don't we just jump in right there? Is the market now worried about Germany and what's happening in Europe? Is it worried about interest rates? Is it a little bit of both? What's Argus thinking these days about the volatility in the market?
Well, sure, Michael. Let's drill down to that. And thanks to you and Dom for having me back on tonight. I'm glad to be here.
Happy to have you.
So we're still bullish on stocks, and I think we tried to make this point a few weeks ago. There are several positive planks in our platform, including the rebounding economy, which you two just talked about. I think the first quarter GDP results will be out at the end of April. That's probably going to be around 6% growth. That's China and India growth, right? That's not industrialized nation growth. So, and it's probably going to get better before it gets worse, because we've got the 1.9 trillion coming into the economy, right now at the start of the second quarter. And then I was reading the headlines today. There's another $3 trillion plan lined up to spend on infrastructure. So the economy is good. The second plank is the earnings outlook. It's a quiet earnings time right now, these last few days in March, as the first calendar quarter winds down. But in 2 or 3 weeks, we'll start the first quarter earnings reporting period with the banks and then a lot of the industrial companies. And we're expecting to see earnings growth, much, much better than economic growth. We think earnings growth can be 25% for the year. So that's another positive factor for stocks. And then the third factor I'll touch on, and it kind of goes against what you guys are saying. Yes, long-term interest rates are higher than they were a year ago, or even against last summer. But boy, that was almost a treasury bond bubble, right? Of a 0.6% yield on the 10-year bond. And I don't think that bubble is popping. I think some of the air is coming out, and treasury yields are moving back closer to normal. We've got a more normal upward sloping yield curve, which is good for the market and good for the economy. And on a historical basis, a 1.5% 10-year treasury bond is still quite low. I think it was 6% when I bought my first house in 1994, right? So we're still in a low interest rate environment, and that favors stocks and growth stocks. The one thing we don't really have is, you know, bottom level valuations on stocks. And that's because earnings remain depressed and stock prices have moved ahead. So we can't really say the market is undervalued here, but we can say that the economy is growing, corporate profits are going to start growing fast, and interest rates remain low on a historical basis. So we're still have a positive outlook for stocks here.
John, if we get the kind of growth that you're projecting, even the Fed is talking about, and as I mentioned earlier, that some people on the street think those numbers might even be conservative, we could see the multiples on the S&P drop, right? If the earnings catch up to where the stock values are today and maybe are going to go down the road, then this is not really an overvalued market.
Right. I try to make that point in some of our reports. You know, what could change that would make the market look more attractively valued now? And one would be a sell-off in stocks, which would be kind of painful, but it would, you know, improve valuations. But I think more likely is to your point, Dom, is that corporate earnings are going to recover to all-time highs later this year, just as we expect the US GDP will recover to all-time absolute highs. The components will be different, right? The services won't be as high as it was before, but overall US GDP is going to get back to all-time high levels. So will corporate earnings. And I do think that, you know, even if interest rates, long-term rates drift closer to a 2% yield on the 10-year, the stock market valuations are going to look better based on the stronger earnings.
So John, to that point, is it counterintuitive to think that 6% GDP makes you nervous? You know, that it's too frothy?
Well, you know, I guess when you think about the year we had last year, Michael, right? We had a 30% downswing and then a 30% upswing.
Mm-hmm.
So even mid-single digit numbers are kind of closer to normal.
Mm-hmm.
And of course, conditions now still are nowhere near normal. Unemployment is still higher than it had been prior to the pandemic. Again, we've got all this fiscal stimulus coming, all the savings that people had built up during this period when they couldn't travel, they couldn't go out. So you're going to see a lot of pent up demand unleashed over these next 2 or 3 quarters. But I don't think that's permanent pent up demand. I think that's temporary pent up demand. And we'll be back to something more normal, you know, perhaps in 2022.
Okay.
And John, would you take that same logic and think about pent up inflation, in that we might have some pent up pipeline inflation because the factories aren't up to speed yet and the system's not up to running yet. And then eventually that'll open up and we could have less inflationary pressure later on in this year?
I think we're seeing that right now, Dom. If you kind of tease apart the different inflation data points, we look at about 12 every month. And the ones that are at the producer price level, the very base of the economy, inflation there is something like 15 or 20%. But by the time that is processed through the economy and gets to the consumer, our average consumer numbers are about 1.7%. That's what the Fed is looking at most closely. Those are still below the Fed's target of 2%, but that inflation is starting to work through the pipeline and will inevitably push up those core consumer inflation numbers closer to 2 and maybe a little bit above 2 for a few months, which the Fed has said it's not worried about seeing, so long as it feels that this is just The higher prices of copper, which had been so depressed a year ago, the higher prices of oil, which turned negative for a few days last year. As those settle down, the overall pricing pressures are expected to abate as well.
John, could you talk a little bit about what is happening in Europe with new shutdowns happening, and are you concerned about a possible domino effect creeping into our country?
Well, Michael, that had been one of our risks that we talked about heading into 2021, that there was a lot of real high expectations for an even stronger recovery in Europe than here in the US. I didn't buy into those forecasts, though. Europe is still coming off of Brexit with major changes to currency valuations and regulations. Europe has had negative interest rates in many countries now for several months, signaling that the central banks in Europe are really working extra hard to try to stimulate the economy and haven't been able to do that. And then as we look at some of the industrial data, the purchasing managers surveys, those in Europe have tended to be below that 50 level, which signals contraction. So we've thought for a while that Europe could be a disappointment, and we're seeing that now, and that's even being exacerbated a bit by the whole vaccine controversy with AstraZeneca. Knock on wood, in the U.S., we're not having those issues, and the vaccines are getting out even more aggressively than President Biden had said they would. So I think we're on track to recover our health, even if Europe doesn't. What that might mean, though, is one of the tailwinds that the market has had in the past year has been a falling dollar. And again, that goes to those expectations that money will come out of U.S. securities and go back home, perhaps back into Europe, and reflating the euro. We've seen the dollar decline. That makes our export goods on markets more affordable and more attractive, and is a tailwind to a lot of industrial companies and software companies and healthcare companies that do a lot of export business. But if Europe is going to slow down, then we'll probably see the money come back into the US. That'll push up the dollar, and that might act as a bit of a headwind against earnings later this year.
And John, especially on multinationals, right? If we're counting on U.S. multinationals being able to expand their business and sell overseas, if we have a higher dollar and Europe can't afford, because they're not quite as far along as we are, that could affect those earnings as well, right?
It could, Dom, but a company we follow pretty closely did report its earnings last week, and that was FedEx. And they said that their European business, their international business, is doing very well. So no early signs of that, but that certainly is a risk.
Do you see us in a trend of risk on, risk off for an extended period of time, or do you just see the market right now just being hypersensitive to the headlines that we're experiencing?
Well, Michael, one of the numbers we follow just to get a sense of what people are thinking about the market is that VIX volatility index.
Very
right?
important.
The fear index.
Mm-hmm.
And the VIX in 2018, 2019, and I'm simplifying this a little bit, was like 10 or 11. It was very low, near all-time lows, and pretty consistent there. So last March and April, it shot up to 70, 80, has come back down, but still hasn't come back down to that 10 to 11 level. It's been in 20 to 30, and it's about 20 now. So there's twice as much volatility in the market today that there was in the relatively calmer years of 2018 and 2019. Of course, was a good year for stocks, up almost 30%. So investors are definitely on edge, and you're going to see these kind of swings as we did in the market today. Dow down 300, S&P down 30. A lot of debate that we're hearing, is this a value market or is this a growth market? And people seem to be embracing the value stocks here, right? The energy stocks have done well, the banks have done well, and that goes against a really pronounced trend that we saw for most of the previous decade, in which growth stocks had much better performance than value. And in fact, in 8 of the 10 years, growth stocks beat value. But there's been, I don't know, I'm not sure it's a reversion to the mean or more just of a focus on value, as these beaten down sectors are expected to report very strong earnings in upcoming quarters. But that's one debate I think we've seen play out. Are we going to go for value or are we going to go for growth?
So what's interesting about that, Dom, and I know you're about to ask a question, I apologize. So the narrative has been changed though, right, John? It's no longer called growth versus value. They're called stay-at-home stocks versus reopen stocks.
Right.
Right? But really what you're talking about is growth versus value.
Yes, right. Your stay-at-home stocks are your drug stocks, the companies that are coming up with the vaccines, manufacturing the vaccines. They're the tech companies and the communication services companies that are connecting us all. And then the restart stocks are the energy stocks, are the cruise lines, are the restaurants and the retailers, the ones that saw so much value disappear over the past 2 or 3 years.
Right.
So, John, I'm just going to pick up the ball from where Mike handed it off. I mean, all three of us have been in the industry for a really, really long time.
Easy with the realies, Dom.
And I'll speak for myself, but it really had become where these growth stocks, these are companies that grow at a substantially higher rate than the average in the markets. I jokingly call them like crack cocaine to money managers. They can't just give them up. They will not give them up. And so it's hard for me to believe that we could look at this picture 6 months down the road and all of a sudden none of them, Wall Street, none of the money managers are just not going to own growth stocks anymore. It's just really hard. It might be more selective, I think, where the earnings and the growth are really more tied to reality. But it's hard for me to believe they're going to give up these growth stocks. I'd love your opinion on it.
Yeah, I think you're onto something there, Dom. And it goes to, the real composition of our U.S. economy and what is driving our economy. Back when value was king, perhaps it was, the railroads or the manufacturers, the big factory companies that had the big capital investments. But now it's more the network companies, the Amazons,
the cloud companies,
the artificial intelligence companies. It's the innovative companies, and it's more, brain power than it is brawn power or bricks and mortars. And I don't see us going back that way, right? If you look at the energy sector and the tech sector, the energy sector maybe 10 years ago was 10% of the S&P 500 and tech was maybe 15%. Well, capital has flooded out of energy. It's now about 3%, and that capital has moved to technology because that's what's driving our U.S. economy, and that's what's driving our growth. And that's supported by these innovations, but it's also supported by something we talked about earlier, the low level of interest rates, right? When growth investors value stocks, they're projecting future earnings streams, and then they're discounting them back to net present value using current interest rates. And when interest rates are low, that discount rate is low. And so those profits coming back are higher, and the profits are worth more, and the growth stocks are worth more. So as long as we're going to have a 10-year rate below 2.5%, I think we're going to have an environment for growth investors to generally prevail over value investors. Now, there may be 1 year out of 5, like we saw in the last decade, where value is the answer. But I think the long-term focus is going to be on the growth part of the market.
So John, we have a minute. What is Argus worried about in 60 seconds or less?
I think I'd go back to a point that you guys made earlier, and that would be, can the Fed stay ahead of inflation? One thing we haven't talked about tonight is the rising debt levels of GDP, and that's only going higher with the 1.9 trillion and the 3 trillion. At some point, that's going to have to be paid off. That's going to result in higher interest rates. That's going to result in a weaker dollar, less confidence in the U.S. system than we have right now. That's not a problem for 2Q21, but that's something that I think those economists at the Federal Reserve should be thinking more about.
So that was nicely done, because that gives us a reason to bring you back for a third visit so we could discuss that in greater detail.
I look forward to it.
John, as always, I wish we had more time, but looking forward to our next conversation.
Thank you, Dom. Thank you, Michael.
John, thank you and stay safe.
Appreciate your time.
All right. Bye-bye.
Okay, we'll be right back with Jordan Kimmel and his guest.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
And welcome back, everybody, to the Lebenthal Report. I'm Jordan Kimmel, the Chief Equity Strategist and Portfolio Manager. And it's a true delight to bring on a friend for many years right now, a colleague. It's Michael Carty from New Millennium Advisors. And Michael, thanks so much for joining us today.
Oh, it's my pleasure, Jordan. Always good to get together with you.
No, it'll be really fun. And just to set this up, Michael, I mean, we met over 20 years ago. I think you're still running Quaff a Few, and I didn't mispronounce that. You'll get into what that is. And I think it's one of the really top organizations for finance in America. We met 20 years ago. We were doing CNN shows together.
That's right.
Everybody, Michael is not only a guy who they brought on television to talk a lot about what he thought the market would, but he was a portfolio manager, and it's a little different talking about it than doing it. I think the Quaff a Few has over the years had a steady stream of really the top advanced quantitative guys. And I remember you and a couple of your Padres were actually the guys who were in the front of the ETF revolution.
Oh, we were early
I enjoyed
adopters.
meeting the Spider Woman through you. And
right.
I know that
Kathleen Moriarty, the Spider Lady.
Right.
Yes.
And the ETF world, you were there at the very beginning of it. So
Yeah.
Michael, what I want to do right now is let's get right into the present. You probably are more familiar with my models than almost anybody, having back tested them and kicked them around 20 years ago. But that's a bottoms up process. I
Yes.
know that what you do a lot is top down and really think what the Fed is doing, what the economies and sector. So why don't you kind of lay out, like John did, what your expectations are globally, big picture, and then we could drill down a little bit.
It's funny, I had a great deal of agreement with him. I believe that I personally think we're out of the post-pandemic part of the market. And of course, now we're in the expansionary phase. And that expansionary phase is going to continue as long as the vaccines are still put into arms, and as long as people are able to get back to work, the lockdowns go away, people start becoming more productive, and all of a sudden we have this more products, more services out there, and it feeds on itself. And that's likely to continue for the next 6 to 12 months.
Right.
And maybe even longer than that. So we're going to have probably high single-digit growth. He mentioned 6% on GDP. That's easily possible for 2021. He talked about 25%, 20 to 25% in earnings on the S&P 500. That's easily doable.
Big
Because
numbers.
remember, we have no earnings to speak of. It's
Okay.
these companies are just getting back into operation, and that's going to make everything look pretty good. Unfortunately, there are clouds forming at the end of all of this, because when you get to a full employment state and you start chasing, you start spending money, the consumer sentiment, for example, consumer sentiment is coming out on Friday. That's going to be an interesting number to watch. And then you get into what's going to happen on the macroeconomic level when we have massive debt, massive government funding, the $1.9 trillion stimulus, and coronavirus, only 9% of that is really going to go to people who have problems with the vaccine, et cetera. And then we're going to have a 3 point stimulus $3 trillion stimulus package. That's going to be very, very painful in terms of how we're going to pay for it.
But Mike, hold on a second. Let me push back a little bit, and then I want to get into deeper things, because I don't want to spend too much time on this spot. But when we look at history, and I remember the old days when they would talk about 6 and 7% earnings, and that had to do with 3% inflation and 3% unit growth. So come on. I mean, we went on life support. We heard about zero interest rates. We were shocked, and we said, buy the stock market. It's 0%. Why do we even want interest rates or the economy to stay on life support? I don't really believe 2% interest rates is going to derail anything. Am I wrong?
They won't stay at 2% very long, particularly if we have inflation next year. We're probably going to see some signs of that towards the end of 2021. But then remember, everything depends upon energy prices, and energy prices are going up. Going to have higher taxes, income taxes. We're going to have even higher payroll taxes. So with these taxes going up, it's going to start pulling away from productive things. Remember, inflation is too many dollars chasing too few goods. When you have a lot of dollars chasing greater productivity, you don't have inflation. But when productivity is shrinking and the dollars are trying to buy it, that's when you have inflation, and that's when we're likely to have inflation next year.
So you're more afraid, you're saying, of inflation than you are. That's the main fear you have, is that the valuation of the market would look overvalued if rates go too high?
Oh, I'm saying next year. I still think we're in the expansionary phase of the market. The market will continue to go as long as people are getting back to work, the lockdowns disappear, restaurants open up, businesses open up, businesses start looking at what they want to do in terms of expanding their operations, hiring more people, getting things done. I think that's all going to feed to a very, very strong market this year. 25% earnings this year is going to be a really nice earnings. We had 30% increase in the stock market last year. Of course, we've had a couple of shaky weeks, but then everyone's still trying to sort out what's going on. But I think at the bottom of all that sorting out, we're going to say the market is going to be going up, and we want to participate.
Okay. So, Mike, I have to ask some questions. Not too many people are able to answer this. What I hear you saying before I move on is the environment is good. The market environment drop back is good. But then we, as portfolio managers, have to actually fill the portfolio.
Oh,
so the debate
yes.
that went on a couple moments ago with John, and I hear it all the time, it's value versus growth. You happen to know I'm a factor manager. I work with factors, and not too
I'm
many
intimately familiar with that. Yes.
So please describe what kind of factors you'd be looking at, what combination of factors, if you will, if you were doing some maybe bottoms up work.
Well, the bottoms up work would be, first off, if we're in an expansionary phase, we want to be in growth stocks. You may not want to be in all the FANG stocks.
Okay.
Consider the fact that we've got Amazon and we've got Apple. They're going to be here 5 years from now and maybe 10 years from now. On the other hand, a lot of the communication stocks are going to be competed against through because of certain political forces, as well as just competitive forces and technological development. So you want to be more selective when it comes to stocks that going to be good in an industrial economy and consumer economy. You're looking at consumer durables. You're looking at industrials. You're looking at even some of the basic materials are going to start looking good. These things all happen because as the demand for these products and commodities, including labor, goes up, the prices of those items go up. So we're going to start seeing some commodity prices go up. We're going to see labor prices probably go up. Certainly unit labor costs will go up. A lot of good things are going to be happening. And that means that you could get away, you're going to still have good communication sector,
Mm-hmm.
a so-so consumer staple sector. You're going to have a strong durable sector. You're going to have a good, strong financial sector. The banks are going to be in good shape. You're going to have good industrials. The healthcare sector is going to be in very good shape.
Okay.
Technology is going to be in good shape. So a lot of these sectors are going to go on, move on.
So,
It's
so,
big
so I think
question.
the sector work is
Stocks.
perfect. So let me do a little fun exercise for a second, just a little,
Sure.
humor here too. So, remember what the definition of a long-term investment is, right?
Yeah, a long-term investor is a long-term investor is a guy who looks at his statements every month.
No, a long-term investment is a short-term investment that didn't work out, right?
Oh,
And
okay,
it suddenly
that's true.
became
Well,
a
what is an
long-term
investment? What is an investment?
But so
A
the
speculation that did.
So listen to this thought I'm having. So growth versus value. There was a decade in time when Exxon was a growth stock,
That's
right?
true.
Because it had revenue growth and margin growth and cash flow. So when the discussion about growth versus value, just because something trades lower than it did a few years ago, it doesn't make it, in my opinion, a great value. It's a
No,
little
it
semantics.
doesn't.
What I'd like to do,
Right.
listen, I saw a note come up saying that we have a few minutes to go, about 4 minutes. I'm going to ask the engineer if he could bring on Dom and Mike,
Sure.
who run a lot of the big picture, not the SMA money, but the ETFs, the mutual funds, which really they need to know kind of what areas to look at. So Dom and Mike, any questions for Michael, who's really a both portfolio manager and an economist?
Why don't you go first?
Sure, I'd love to. So I'm really thrilled you brought up this discussion about growth stocks because we're starting to get a sense that you should switch your entire portfolio to value stocks, and that's the only thing that's going to work, at least over the next 6 to 12 months. And there's some really good quality growth stocks. You named a couple that I think are going to surprise and impress the markets. And we should not be swinging the pendulum all in one area or the other. I'd love to hear some more thoughts on that subject.
Yeah, as a matter of fact, it'll be too early to swing the pendulum because if we are in an expansionary phase of the market coming out of the pre-pandemic phase or the pandemic phase, then we're still going to have people going back to work. The vaccines are going to be put in everybody's arms. They're going to have demand for products. There's a lot of pent-up demand out there, and these stimulative checks are probably a lot of them are being saved rather than used for immediate consumption. So with this pent-up demand, people start traveling again when they're able to, going across borders without masks and all this and everything else. There's going to be the high-tech stocks are going to take advantage of that because they have better leverage on their assets than do some of the older, more industrial stocks. We won't really have to swing the pendulum to the value side, or better yet, I'd include the investment side, because what you're going to want to be in are defensive stocks, which do have value, but they have value primarily because the dividends are sustaining them, and any cash that's coming in can be used to buy back securities. So you have an underlying value for those high income stocks. But I think you have plenty of time to get into them.
Michael, you mentioned rising taxes, and I agree with you. Taxes have to go up to pay for all this stimulus. When do you see that really, coming to the forefront? Is it later this year? Is it the beginning of next year? When does that start to percolate?
It depends on how fast it can be implemented. You have to be looking at whatever indicators there are to show you that they are being implemented. There's a lot of resistance to some of the programs because our Senate is basically divided in half, with Vice President Harris having the deciding vote on a lot of this. But there are a lot of blue moderate Democrats who would be afraid of a midterm election if they don't become more moderate in some of their programs, including especially taxes or the payroll tax. Those things can be delayed or sped up depending upon how much pressure those politicians are under. Now, if we see that the taxes are going to go through and we're going to have a $3 trillion stimulative package. You remember when everything was shovel ready that wasn't shovel ready?
Yes.
We could have another one of those. That would be very, very painful to the economy, and that would mean that 2022 is going to be a hard year. So, but I'd be looking more for what some of the politicians are doing, where the voting is going. Politics are going to have an awful lot to do with how fast these taxes are implemented, and also the states in which they're implemented. Think about the people who are moving from California to Texas and from New York to Florida.
Believe it or not, we ran up to break already here, Michael. So
it's a shame.
I'm thrilled that you came. I'm thrilled that you joined us. You've seen more and more market cycles. And folks, the good news is I talk to Michael all the time, and I have him looking over my shoulder and always trying to knock down the risk in the portfolio. And I'm thankful for you, Mike, and your insights. And thanks so much for joining us.
Well, I'm very grateful for the invitation. It's good joining you, Dom.
Michael, would
And
love to have you back. Okay.
Thank you,
Thanks.
Michael.
Be right back with more Lebenthal Report following this quick break. Thank you.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella. And Dom, as we were on the break and I was thinking about our two guests, what I was thinking about is what this podcast has actually done is peel the onion back for our clients and really gave them a peek to how we spend a lot of our time. We have these sorts of conversations frequently, and now we're just having it on Voice America and on YouTube and sharing what we have the fortuitous occasion to do quite frequently.
Well, I always have a different version of this joke that I'm not the smartest guy in the room, but these two guests tonight kind of proved it, right? So what was going on and goes on all the time, frankly, is that we get to have conversations with people like this on a regular basis, right? Daily, weekly basis. And it influences us on how we allocate and how we rebalance the portfolios and when we allocate and when we rebalance and clearly the advice we're giving to our clients. And people are always like, how did you know? And what made you come up with that idea? And what was the thesis behind making that decision? And what this podcast is supposed to do, Mike, and you were spot on, is give them the insights into what we're hearing and what we're thinking. And hopefully that we're trying to make as rational decisions as we can every time.
And in addition to that, it's what also keeps us calm, right? It's what also keeps us with a steady hand on the wheel, because we are able to have these conversations and make a rational decision and not get caught up on the headlines.
Look, we've all seen those mountain charts, right? Where the S&P or the Dow goes straight up, right, over the last 30 years. And you and I both know it was never that smooth a ride, right? The ride was just a little bumpier than that, right? So we at the end of the day, our job is to make the ride a little smoother on behalf of the clients. But having guys like this and other guests that we've had, it just makes our job a little easier, and to be able to pass that message on to people that put a lot of faith and trust in us.
Yeah, you're right. Clients will say to us, well, how did you know? And how'd you make that decision? And why are you so calm? But, we get to hear them, and they're the ones who talk us down off of the ceiling, right? They're the ones who calm our nerves and keep it rational.
And rational is the key word, right? And we saw it again today. The market reacted to some noise that came out. Maybe they didn't like the word "the" when the Fed governor said something, or there was some rumors about the AstraZeneca vaccine in Europe, and boom, the Dow's down 300 points, and then NASDAQ is down, and it's just noise, right? It's our responsibility to go, yeah, that's kind of important, but in the big scheme of things, it's okay, and we're going to get through this.
And that really is the point, right? The big scheme of things, and we talk about headline risk all the time, and in the big scheme of things, we are on the right track, and that really is the bottom line. We are on the right track. We may not get there exactly on time, but we're on the right track.
And both our guests were really very clear about where their expectations anyway are for the economy, the balance of this year into next year, and what kind of companies we should have in our portfolios and how to best take advantage of it. But I don't think either guest left ambiguity about the growth prospects for this great nation of ours.
No, there's growth prospects, and beyond those growth prospects, there's inflation, there's higher taxes, there are things to worry about down the road.
And we will.
And we'll cross those bridges when we get to it.
So,
and on that note, I think our time is up.
Well, have a great evening, Mike. Thank you to all our guests, and looking forward to next week's.
Good night, everyone. Thank you for joining us.
Be safe.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.